This is urgent, okay? Today I'm talking about how to build a tax plan or create a tax strategy. And this is important because listen, 2021 is almost over and you have to build a tax plan the year before tax season starts. Okay, let me say that again. You want to figure out how to build a tax plan the year before the tax season starts. So even though you will file your taxes in 2022, you should have implemented your tax plan in 2021. And the reason why this is so important is because almost every tax season, I have clients who see their tax liability or they see their tax refund and ask, okay, what can I do about this number? And sometimes as a tax professional, I'm able to actually help, but more often than not, it's too late to do anything about their tax outcomes because the tax year is already over with. So in this video, what I want to do is help the people who want to be proactive about their tax situation, learn about how to build a tax plan step by step, even if you're a beginner. Stay tuned. Hey there and welcome to our channel. I'm Sean with Life Accounting, the accounting company that helps you save on taxes and build more wealth. Please, if you like this topic, do us a favor and hit the like button for the YouTube algorithm. It really helps this video reach more people who also want to learn about how to create a tax strategy. All right, let's go ahead and dive in. So step number one, understand your tax bracket. It's almost impossible to plan for the future if you don't know where you are in the present. And so it is key to understand how much you pay in taxes, even if you are someone who is getting a refund, because you are still paying taxes at the end of the day. Okay, so step number one is figuring out your tax liability. And the best way to do that is to make sure you understand your tax bracket. Now, here in the United States, we have a progressive tax system, meaning that the more income you make, the more you get taxed. So I'll go ahead and put up on the screen right now the 2021 tax brackets. Now, these tax brackets often confuse many people because people think that they should just simply multiply their total income by the tax rate in the bracket that they fall into. So for example, if you had a household income that made $100,000, then what most people would do is multiply that by 24% and think that their tax liability is $24,000. But that is wrong. Okay, instead, the IRS divides your income into chunks and taxes each chunk at the corresponding tax rate. For example, if your household made $100,000 of taxable income, then only $13,624 will be taxed at the 24% tax rate. And in total, you'd be looking at something like $15,103 in tax liability after the standard deduction instead of a tax liability of $24,000. Which brings us to step number two of creating a tax plan. Understand tax deductions and tax credits. Okay, so by default, every American household receives what is called a standard deduction. And this is a tax deduction that is basically given to you. So for the 2021 tax year, the standard deductions are $12,550 for people filing single and $25,100 for people filing married jointly, and $18,800 for people head of the household. Now here's the thing, okay? You don't have to take the standard deduction because you can do something that is called itemize your deductions, which is more advantageous to use if you expect to have qualified expenses or deductions that exceed your standard deduction amount. Okay, now, anyway, tax deductions and tax credits will influence how you create your tax plan because you can reduce your taxable income, thus lowering your tax bracket. Okay, so what is a tax deduction? These are usually qualified expenses that you use to reduce your taxable income. On the other hand, a tax credit is much better because you get a dollar for dollar reduction on your tax bill. So for example, let's say that you make about $48,000 in income and you are looking at owing $4,000 in taxes. Well, if you have a $3,000 tax deduction, that will reduce your taxable income from $48,000 to $45,000, which in turn would reduce your tax bill by $350. So now you owe $3,700. However, let's say you have a tax credit for $1,000. Well, that will reduce your tax bill by the total $1,000. So now you would owe $3,000. That's a pretty big difference, right? So it's very important to know what tax credits and tax deductions that you currently qualify for when you're thinking about how to build your tax plan. And once you have that, then you can determine what tax credits and tax deductions you want to go after proactively, all right? After proactively. Now, we have some great videos breaking down different tax deductions and tax credits, which I'll link to in the description below. But I do want to just make sure you're taking advantage of some of the obvious ones, like writing off college education expenses, home office expenses, mortgage interest and property taxes expenses, and getting credits like the child tax credit and the saver's tax credit. All right, before I continue, is all of this helpful so far? If so, please tell me in the comment section below if you're learning anything from this video or if you have any questions. Okay, moving along to step number 3, determine your tax liability after deductions and credits. So after going through step 1 and step 2, you should be able to reasonably estimate what your tax liability will be after you're considering what tax deductions and credits you want to go after. Now, before you rush into creating your tax strategy, now you want to ask yourself 2 very important questions. Okay, number 1, are you okay with your current tax outcome? So you may find that after doing step 1 and 2, that you are paying very little in taxes and that you don't need to make any adjustments. Or you may find that you believe in paying your fair share and you are okay with the tax rate that you pay. Which, by the way, the average American pays about 14.6% of their income in taxes every year. The second important question that you need to ask yourself is, are you okay with taking home less income? That's right. Are you okay with taking home less income? Because here's the deal. Most advanced tax strategies involve you making investments into the future. The fundamental tax planning idea is that you defer income and you accelerate your expenses. So you really need to ask yourself if you are okay or if it's even possible for you to take home less income today in order to have more income in the future at a lower tax rate. If so, then you can move on to step number 4, choose your tax strategy or strategies. Now, depending on how much tax liability you have, you may only really need one solid tax strategy. But in general, as you make more income, you will need more tax strategies. Here are 3 tax planning strategies that you should know about. Number 1, start or invest into a business. Okay, most of the time when you are starting a new business, you have startup costs with 0 income. So if you are actively building up your business and incurring expenses, then usually at the end of the year, you will end up with a business loss. And then you can use that loss as a deduction against your taxable income. And I personally like this a lot because at this point, you're actually building a real asset that you own and control for more future tax write-offs. Strategy number 2, put your money into a 401k or an IRA. Now, these are tax shelters. So essentially, the IRS doesn't tax you on what you immediately contribute to these accounts. And at the same time, you can use these accounts to invest in other assets like stocks or real estate. Now, the main pushback I get on this strategy is that you have to wait until you reach retirement age to get your money back tax-free. But listen, if you don't necessarily need the income, then this could save you hundreds of thousands of dollars in taxes by the time that you retire, and every little bit helps. Now, Karan has a great video breaking down 401ks versus IRAs, which I'll link above and in the description below. Tax strategy number 3, maximize your health saving accounts, also known as an HSA. So health saving accounts are tax exempt accounts you can use to pay any medical expenses that you have. So think about stuff like prescriptions or high deductible insurance plans, etc. Okay, even Amazon has an entire catalog of different products and services you can buy using your HSA or your FSA account. At some point, you're likely going to have to pay for something medically related, and why not use your money that is tax-free? Now, with an HSA plan, you can contribute about $3,600 every year as an individual with high deductible health coverage, or $7,100 as a family with high deductible health coverage. We also have some really great videos breaking down health saving accounts, which I'll link below. Now, of course, these aren't all the tax strategies that you can deploy, but hopefully this gives you an idea of how to create a tax plan. So make sure you're subscribed to our channel, because we definitely will continue to let you in on different effective tax strategies. Okay, step number 5. Implement your tax plan. Now you have everything you need, okay? You should know your tax liabilities. You should know what tax deductions and credits that you want to go after. You should even know if you want to chase a tax plan and a few strategies that you can implement immediately. So go out there, do some math, set up your accounts, and figure out how to build your own tax plan. Now coming up next, we have 2 videos that I referenced earlier, so make sure you check those out next, and we'll see you over there. Peace.